Hi everybody, this is Thomas and I'm here with our market summary for the first quarter of 2015. I'm going to go through the material pretty quickly, but if you want to pause it and take a look at the detail of any slide, you're welcome to do that. Before we get into the market report, let's take a look at the client review, which we've updated our software, and so the review looks a little different. We think that the general formatting is cleaner, and we hope you like it, and we've added some information. In the past, we've always had the first quarter and the year-to-date and the investment change, your profit or loss after all fees from the quarter and then accumulated through each quarter. And now we're showing this since inception. So you can see from the beginning of time, from the beginning when we started working together, what the cumulative profit or loss is in this field right here after all fees. So that's new. We're also showing a little bit different time sequence down here on returns over time. Returns year to date, 1 year trailing period, a 5-year trailing period, and a 10-year trailing period. We haven't shown this in the past. And then of course since the time we started working together. So I hope you find this helpful. I think the data is going to be, there's a little bit new data in some of the other reports, but these are the big highlights. So let's dive into what happened in the market. It was a relatively mellow quarter and the market was in general higher, and these are the news items that happened during the period, and I highlighted a couple, which is globally interest rates continue to go down, and that affects our portfolios. Since we're diversified, we have for most clients about 60% stocks and 40% bonds, and that means our bond portfolio, the bond portion of our portfolio, is performing not as well as we'd like. We're doing everything we can to try to find increased yield while managing our risk, but that is the reality of the world we live in. And then mixed economic signals were coming through. Job growth was strong, but looking forward, economists were worried, and inflation was down, and that drives interest rates down. And the last thing I highlighted was that the NASDAQ or tech stocks finally reached the price that they were back in 2000 before the tech bubble. So let's jump in. This slide always shows 6 categories, 4 stock categories and 2 bond categories, and everything was up for the quarter, which is great. And this dives into a little more detail as far as asset classes, more categories, with the real estate was the best performing category. Everything except for one category is up in the period. U.S. stocks, same thing, very strong for the small cap growth, but good returns except for one category of large cap value. International stocks, which have been very poor for a couple of years, have come back strong over the last couple of quarters. That's why we stay diversified and we don't try to jump from sector to sector. We stay appropriately allocated in all of the asset classes globally. So now we're being rewarded for staying in international developed. And we're still in emerging markets, and that is also, like the developed markets, bouncing back strongly over the last couple of quarters. Here's the performance by country, with developed countries over here, and all but a few were up in the quarter. And then the emerging markets, which are more volatile, it was about half and half, with Russia bouncing back strongly, Greece at the other end of the spectrum. Commodities were in general down. A couple of commodities were up. Most were down. I've highlighted natural gas and crude oil. We have very small positions in those, and we're thinking about increasing our positions in energy in general. And here's fixed income. And we can see that the 10-year U.S. Treasury bond is under 2% now, and even the long-term bond is just a little bit over 3%. These 3 bars show interest rates from short term, where you get practically 0 on your money, to 5-year, where you get a little over 1%, and the 10-year, which is just under 2%. And here's what they were last year at this time, and this bottom line is this year, and this is about a quarter ago. So rates have fallen pretty significantly in the last year, even though the Fed said they're getting ready to raise rates. The market is not caring. For whatever reason, interest rates are down, and they've been down for a long time, and they look like they're going to stay down for a while. So, as I said before, that puts pressure on everybody that is trying to make money on fixed income, and in general, it has a tendency to push people out of fixed income and into equities, whether it's appropriate or not. This last slide is a editorial from DFA, making an analogy between DFAs and Wynn Capital Management style of investing and the MasterChef program. I found it very entertaining. And that's it. Pretty quiet quarter, not much to add to that. Here's our contact information, and I hope you find the material helpful. And if you want to give us a call anytime, you're welcome to. Thanks a lot. Bye-bye.